Hello everyone, and welcome to today's webinar on the Scientific Beta Dynamic Defensive Solution. I am Severin Sibeli from the marketing team at Scientific Beta. Today's webinar will be hosted by Daniel Aguet, who is Index Director at Scientific Beta, and by Eric Shirbini, who is Global Research and Investment Solutions Specialist at Scientific Beta. Before we begin, I just wanted to let you know that you have the possibility of asking questions if you wish to do so. So you just have to use the raise hand sign at the bottom of your screen, and we will unmute your microphone so that you can ask your question. You can also use the Q&A function and type in your question if you wish. So I will now leave the floor to Eric and Daniel for today's presentation. Thank you.
Thank you very much for that introduction, Severin, and I'd like to welcome Daniel, who will be joining me with this presentation here today. So the topic for today's webinar is dynamic defensive solutions. So what we would like to do today is address some of the serious shortcomings of existing defensive strategies through the construction process, through looking at a better way to construct defensive equity strategies. Then secondly, defensive equity strategies are not always defensive, and we witnessed that recently during the COVID crisis. So what we would also like to do is look at ways to explicitly control the risk of defensive strategies to maintain their defensiveness even throughout a crisis, instead of just relying on the defensive properties of stocks within defensive equity strategies. And then lastly, traditional defensive strategies also suffer from having a high exposure to carbon, have a high carbon exposure. So what we would also like to do is also address this high carbon exposure and think about trying to reduce the carbon footprint of a defensive strategy in order to reduce our exposure to climate risk. So that's a very broad overview of the presentation here today. So in terms of an outline, I would just like to do a brief introduction about defensive equity strategies. Then I'd like to turn to the drawbacks of traditional defensive equity strategies, and there are 5 main drawbacks that I'd like to address. Then in the third section, we will look at ways to address each one of those 5 different drawbacks. In the fourth section, I'll be joined by Daniel, who will look at ways to forecast the volatility of defensive strategies in order to be able to explicitly control the risk of defensive strategies. And then in the fifth part, we will look at what all these design implications have in terms of the performance of this dynamic defensive equity solution. And then finally, we will draw on the major conclusions of this webinar. Okay, so let's get going. In terms of an general introduction to defensive equity strategies. So defensive equity strategies, there are 2 real main benefits that people and reasons why people use defensive equity strategies. First of all, it provides some additional protection on average in a down market. And furthermore, it tends to provide, defensive strategies tend to provide better risk-adjusted return compared to the cap-weighted index over the long term. And the reason that defensive strategies are able to provide better risk-adjusted return compared to the cap-weighted index is defensive strategies are exposed to the low volatility risk factor, to low volatility stocks, and it's been well documented that there is a premium associated with investing in low volatility stocks, as highlighted in the classic paper by Franzini and Pedersen. Now, defensive strategies tend to provide exposure to low volatility stocks explicitly, either by selecting low volatility stocks, or alternatively, another process, construction process that is used to design defensive strategies is an optimization approach. And in the optimization approach, you aim at the portfolio with the lowest volatility on the efficient frontier, better known as the minimum volatility portfolio. So you can either explicitly select low volatility stocks, or you can design defensive strategies using this kind of optimization approach, which targets the minimum volatility portfolio. So what we would like to do now is look at some of these common approaches that are used to construct defensive strategies and highlight some of the drawbacks. And there are 5 main drawbacks that we would like to highlight. So we list here the first 3 drawbacks. First of all, many defensive strategies have negative exposures to other rewarded factors. Now, the reason for that is when you tilt towards the low volatility risk factor, because low volatility is uncorrelated or decorrelated from some of the other well-known risk factors like quality, like value, and so on, by explicitly tilting towards low volatility stocks, a lot of defensive strategies end up with a negative exposure to some of the other risk factors. And this negative exposure can hurt you in a couple of ways. First of all, it can hurt long-term performance. You do all this hard work to get exposure to the low volatility factor, and then you give away some of those returns by having negative exposure to some other well-rewarded factors. And furthermore, when the low volatility factor is not working, then having a negative exposure to something that is working can also hurt you in the short term, particularly when low volatility is not delivering positive returns. So negative exposures to other rewarded factors seems to be a common problem and we will look at some typical negative exposures of common defensive strategies that we need to be wary of. Secondly, a lot of defensive strategies lack diversification. Strategies that use an optimization approach tend to be concentrated in a very, very small number of stocks. They tend to put a lot of weight into a small number of low volatility stocks, or tend to use cap weights, which are extremely concentrated. And what this concentration does is it exposes you to unrewarded risk, to stock-specific risk, which on average, over the long term, is unrewarded. So we need to also think about better ways to construct defensive strategies in order to reduce our exposure to individual companies, which expose you to this unrewarded risk. Thirdly, defensive strategies also tend to have a lot of sector and regional exposure. So they tend, especially international defensive strategies, they tend to have a residual exposure to different regions. And this regional and sector exposure can also hurt you, particularly in the short term. Regional and sector exposures also over the long term are unrewarded risks. So we also need to think about our sector and regional exposures. So those are the 3 common drawbacks when it comes to constructing defensive strategies. But defensive strategies, and this is the 4th drawback, are also exposed to high carbon risk. Defensive strategies tend to overweight stocks in the utility sector, and we know that utility stocks tend to have a very high carbon intensity, a very high carbon footprint. So in this table here, what we show is the weighted average carbon intensity, which is simply expressed as millions of tons of carbon divided by revenue. And what we see is that for defensive strategies, our strategy even, and the MSCI strategy, it tends to have twice the level of carbon exposure based on the weighted average carbon intensity. And this again is mainly because you tend to overweight utilities which have a very, very high carbon intensity. But it's quite a severe problem, particularly for the low volatility factor. You tend to have a carbon exposure which is twice as high as the cap weighted index. So we need to address this concern as well. And we also need to understand if we can address this concern without harming the performance of the underlying defensive strategy as well. The 5th concern is shown very clearly here, is that defensive strategies are not always defensive. So here we show the rolling volatility of the MSCI minimum volatility index. And you can see that during a market crisis, what tends to happen is you get a spike in volatility. Volatility tends to increase. So just at the time where you want this strategy to be defensive, you have a rise in volatility, and that exposes you to a lot of downside market risk. Now, this is something that we will look to try to control explicitly. And we can see exactly what happened during the COVID crisis. You had a very sharp rise in the volatility of equities, including minimum volatility or low volatility equities. So we will look to try to control this risk as well explicitly. Okay, so those are the 5 main drawbacks of existing defensive equity strategies. So let's look at each one of those and look at how we can improve through the construction process and through explicit risk controls, how we can improve each one of these 5 different elements. So turning first to the fact that defensive equity strategies tend to have a negative exposure to other well-rewarded factors. So we can see in the table here at the bottom of this slide, on the right-hand side, the MSCI minimum volatility index. Yes, it has a good, strong positive exposure to the low volatility factor. However, it also has negative exposure to factors like value, momentum, profitability, and investment, the quality factors. So this negative exposure has a detrimental effect, because what it does is it reduces your overall exposure to well-rewarded factors. The factor intensity, which is simply the sum of the exposure to all the well-rewarded risk factors, for the MSCI index is 0.33. It's actually lower than the exposure you get to the low volatility factor, because you're detracting from the low volatility factor, and this detraction will lead to lower returns over the long term as well. So the way scientific beta addresses this concern, and we do this actually for all of our single factor indices, is we use a high factor intensity filter. And essentially what we do is we first select low volatility stocks. Once we've identified the low volatility stocks, we will re-rank the low volatility stocks on the other factors, and then we will filter out, this is the high factor intensity filter, we will filter out the companies that have a very poor exposure to the other rewarded risk factors. And you can see the result of this filter in the table in the first column. You can see the scientific beta developed defensive low volatility strategy has just a strong exposure to the low volatility factor, but now we've eliminated most of the exposure, negative exposure to the other rewarded factors. In fact, we even end up with a slight positive exposure to other rewarded factors, which will help us deliver better returns over the long term. We can see that the resultant factor intensity ends up being twice as high as the factor intensity of other defensive strategies like the minimum volatility strategy. So this will greatly help us in terms of generating better returns over the long term. However, over the short term, it will help us too, because what we show here in this table is that when the low volatility factor is not doing well, so we call that in the second row of this table, a bear market for the low volatility factor, you can see that a factor like the MSCI factor will do poorly. But because the scientific beta strategy actually has a slight positive exposure to other factors, so when the low volatility factor isn't doing well, we can actually compensate for that by having a positive exposure to factors that are doing well, and therefore you actually end up with a slight positive return even when the low volatility factor is not doing well. While at the same time, when the low volatility factor is doing well, so that's the bull low volatility return that we see in the very first row, we're still able to generate just as high a return. So overall, we actually end up with returns which are about 3% better across bull and bear market returns when the low volatility factor is and isn't doing well, we end up with 3% better returns, and we end up with a better conditional ratio because there isn't as much difference in the returns between the bull low volatility return and the bear volatility return. So this is a very, very important feature, and this is one of the benefits of introducing this high factor intensity filter, is to help us in the short term, when the low volatility factor may not be performing well. So that's addressing the first concern. Now let's address the second concern about defensive strategies, which is the concentration problem. So a lot of low volatility strategies are highly concentrated. The optimization approach tends to lead to high concentration in individual securities and therefore expose you to a lot of stock-specific risk. Or a cap-weighted version of a low volatility index, cap weights are also extremely concentrated, also creates a lot of concentration. So we can see here in the first column that if we look at the effective number of stocks of a low volatility strategy that uses cap weights, the effective number of stocks is very, very low. The effective number of stocks is only 74 for a developed world strategy. Now, if you use a more diversified weighting scheme, which is what we show in the last column, the diverse DMS stands for diversified multi-strategy weighting scheme, you end up with a much higher effective number of stocks. So your low volatility exposure doesn't come from a very narrow range of low volatility stocks. It comes actually from a much broader range of low volatility stocks. And just because you've diversified across a broader range doesn't actually reduce your exposure, your risk-adjusted return. You can see you actually end up with better risk-adjusted absolute and relative risk-adjusted return. But the really interesting part is the change in specific volatility. So you can see that a strategy that uses a more diversified stock weighting scheme, the change in specific volatility is 4%, minus 4%. What does this mean? It means that if you designed a strategy that has similar exposure, similar low volatility exposure and similar exposure to all the factors in a very concentrated way compared to a strategy that uses a more diversified stock weighting system. In other words, if the two strategies have exactly the same factor exposure and the same returns, the strategy with a more diversified weighting scheme will have 4% less volatility for the same return, for the same factor exposure. So clearly having a more diversified weighting scheme helps to reduce our exposure to unrewarded, idiosyncratic, stock-specific risk. Turning to the third drawback of traditional defensive strategies. So when Scientific Beta constructs its defensive strategies, it constructs its defensive strategies on a regional basis. So we construct regional defensive portfolios, and then to create an international portfolio, Scientific Beta aggregates those regional defensive portfolios into an international portfolio using the free float market capitalization of each region. So basically the Scientific Beta strategy controls for regional risk and exposure to macroeconomic risk through regional risk explicitly by ensuring that your weights across the regions are identical to the cap-weighted index. Furthermore, when Scientific Beta constructs its strategy by selecting companies on a regional basis, those companies are selected across three major mega sectors, we call them. So essentially we take the regional universe and divide it into three major industry groupings. We do our stock selection and our filtering within each one of these mega sectors. So we have some kind of balance, overall balance across the sectors. You don't want to do we also offer a sector neutral version where you do more precise sector control, but the more sector constraints that you apply, the more exposure you lose to the low volatility factor. So this mega sector approach is a good balance. It provides good sector balance without really losing exposure to the low volatility factor. And what we can observe from this table here is by controlling for mega sectors, by controlling for the regional risk, you end up with lower exposure to macroeconomic risk. And here we look at interest rate risk, we look at interest rate and credit risk, and you end up with lower exposure to both of those types of macroeconomic risk, which clearly can be important over the short term. Let's now turn to the fourth drawback of defensive strategies, which was their high carbon exposure. So in terms of carbon exposure, what we do at Scientific Beta is we introduce a filter. So before we select the low volatility stocks, what we do is we filter out some of the high carbon exposure companies. So this low carbon filter is applied at the investment universe level before we start constructing the defensive strategy. And it really helps us to support the transition to a low carbon economy, and also it'll help us insulate ourselves from the transition risk as the world moves towards a low carbon type of environment. So this low carbon filter, essentially the effects of this low carbon filter are threefold. We will not include stocks with a high carbon exposure. So these stocks with a high carbon exposure have a detrimental climate impact. And by excluding those companies, we're encouraging a higher cost of capital for those companies, because if we don't include them, the idea is their stock price falls, they end up with a higher cost of capital, and therefore are penalized for this higher cost of capital through exclusion. And clearly, exclusion is a much more stringent way of imposing that kind of constraint. Secondly, the investment, by excluding the worst offenders, if you like, the stocks with the highest carbon exposure, will result in a strategy with a lower carbon impact, a lower carbon impact on climate change as well. And finally, obviously, by introducing this filter, we also reduce our exposure to transition risk. As more and more investors move to a low carbon world, we are more insulated from that, because we remove the stocks that with the highest carbon exposure that are a greatest risk from a transition to a low carbon world. So we'll talk a little bit more about the carbon filter that we use, but the carbon filter actually comes in conjunction with something that we call a core ESG filter. And this core ESG filter also screens out companies that fall short of global standards in terms of responsible investing and responsible business conduct. So let's have a look at this carbon filter in a little bit more detail. So essentially, the carbon filter are based on two types of filtering approaches. First of all, there is the core ESG filter, which is essentially a negative filter. And as part of this core ESG filter that we apply to all of our ESG multi-factor indices, companies with more than 10% of revenue from thermal coal are excluded, companies with coal reserves are excluded, and also companies that use coal in their power generation mix are excluded. So this is a very simple exclusion of companies with an extremely high carbon exposure. So that's the negative filter that we apply. In addition to this negative filter, which is the core ESG filter, we also apply a positive filter where we positively select companies with the lowest carbon exposure. So essentially what we do is we're going to remove also 10% of the companies with the highest carbon exposure, but we want to also ensure that by removing these companies, you don't remove an entire sector as well. So we have some sector controls in place that ensure we have a good diversity across different sectors. Both the negative and the positive filter are applied on a regional basis as well. That ensures that we have good exposure across all the different regions as well to mitigate country biases. So essentially there are two parts, two elements to this filter. One is a negative filter, and the other one keeps companies with the lowest carbon exposure, or essentially eliminates 10% of companies with the highest carbon exposure based on the scope 1 and scope 2 carbon intensity. So when you apply this filter, what impact does it have on the carbon exposure of the resultant index? Well, we observed before that without the filter, the carbon exposure was about 200%, twice as high compared to a cap-weighted index. With the carbon filter in place, we're able to generate a defensive strategy that has carbon exposure which is 10% less than the carbon exposure of the cap-weighted index. And if you want to compare the carbon exposure to other defensive strategies like the MSCI min-vol strategy, our version of the low carbon dynamic defensive strategy has a carbon exposure which is 70% less than the MSCI minimum volatility index. And as we will see in a minute, it doesn't really impact the performance. These exclusions do not impact the performance, but make a big difference in terms of carbon exposure of your defensive strategy. So let me now turn to the fifth drawback of defensive strategies, which, as we noted before, defensive strategies are not really defensive when you want them to be defensive, when you get a spike in volatility, which typically happens during a crisis. So what we want to do is we want to protect the volatility of our defensive strategy. And the way we're going to do that is by targeting the volatility, the historical volatility of our low volatility index. So the idea is to make it less susceptible to sudden rises in volatility. What we want to do is try to ensure we have a volatility which is close to the historical average volatility of the defensive strategy. And the way we're going to do that is, and Daniel will explain the process behind doing that, is we're going to forecast the volatility of our defensive strategy 1 week out. So our rebalancing frequency for this is a 1 week out period. So we forecast the volatility 1 week out. And what we want to then do is, if we see that the volatility is rising, we want to reduce our exposure to the market, to the strategy. And there are two ways we can do that, using a cap-weighted overlay implementation or using a physical implementation. If we see that, if we expect, our forecasting model is telling us that volatility is rising, we can take a short position in the future, and that short position will reduce our volatility, our exposure to the market, and therefore our volatility, to bring it back down in line with the historical average volatility of the strategy. So we can implement it using a cap-weighted overlay, or alternatively, we can just sell down some of the position we have in the defensive strategy and maintain some of that position in cash. So there are two ways you can reduce the volatility and bring it back down in line with the historical average. If we see that the volatility of the strategy is actually below the historical average, we will do nothing. We will just maintain our full exposure to the strategy as it is. So we can see the results of this volatility control. So the blue line here shows the defensive strategy, typical defensive strategy without any volatility control. The red line shows what happens if you explicitly control the volatility by introducing a cap-weighted overlay that reduces your exposure to the market as volatility is rising. We also show the low carbon version of this strategy, and you can see it's very similar to the version that doesn't have the low carbon filter included. You end up with a strategy which has much more constant volatility in line with a long-term historical average volatility. And this reduction in exposure to the market when volatility is spiking will also help you to reduce drawdown risk as well. So Those are the 5 main ways we address the drawbacks. Some of the first 3 ways are inherent in the construction process. The reduction in carbon is done at the universe level, and the 5th one here is done through an overlay control that is applied to the resultant defensive strategy. Now, clearly, an important part of this 5th of the control, the volatility control, is our ability to forecast the volatility 1 week out. So what I'm going to do now is hand over the floor to Daniel, who will talk a little bit about how we forecast the volatility one week out and how accurate that volatility forecasting process is. So I will pause at this stage and hand over to Daniel.
Thank you, Eric. Yes, so can you go to the next slide? So what you want to do when you want to forecast volatility is to try to capture the financial characteristics of asset returns. And so we identified 4 main characteristics that we want the model to capture these characteristics because if you want to use forecasting or statistical model to forecast volatility, then you want something that makes economic sense. Okay, so the first feature of financial asset returns is volatility clustering. So this is a very common feature. So it means that when you observe strong returns, positive or negative, they tend to be followed by strong returns, positive or negative. And vice versa, when you observe very small returns, they tend to be followed by small returns. Okay, so this is the volatility clustering effect. And we capture that with a model that is very well known in the academic literature, so GARCH model, that allows to capture this clustering effect. The second effect is the leverage effect. So when you look at the impact of positive or negative returns on the volatility, there is an asymmetry. Negative returns have more impact on the volatility than positive returns. So it means that when you have huge negative returns, they are followed by important spike in the volatility. And the opposite, when you have huge increase or positive returns, you don't see these spikes in volatility. This can be explained by the fact that when you have negative returns, you increase the probability of default of the company. And so investors react more to negative returns than positive returns. And to capture this effect, we use an asymmetric GARCH model developed by Gloston, Jagannathan, and Runkel in 1993. The third feature is the fact that returns have fat tails. So obviously, they do not follow normal distributions. So to model the fat tails, we use a student T distribution in the GARCH estimation. And the final feature that we want to capture is structural breaks. So when you estimate a GARCH model, what you want to do is to take the most data to have the highest accuracy in the parameter estimation. But when you do that, you might miss some structural breaks. So what is a structural breaks? You can have very strong events on the market that change the unconditional volatility of the assets, such like the COVID crisis, the financial crisis. So what we do to capture these potential structural breaks is that we use 2 different windows to estimate the GARCH model. We use the expanding window to have the highest accuracy in the parameter estimation, and then we use a 5-year rolling window to try to capture these structural breaks. And then we aggregate the two estimation to have one final forecast. So what we did is that we compare this model to a different, more simple model that we can see on the next slide. So we compare this model with historical volatility over the last year, exponential weighted moving average, which is also a very well-known volatility model, and the VIX. which is from the implied volatility of the S&P 500. So we compared these 4 different models from 1995 to 2019, so the starting date of the VIX on the S&P 500. So what we do is that every week we do a forecast of next week volatility, and we compare this forecast to the realization, so the realized volatility. And we square these differences. We take the average across the full sample, and then we square this average of squared returns. This is what we call the root mean squared error. And this measure allows to compare different models in terms of their forecasting accuracy. So the lower is the RMSE, the stronger is the forecasting accuracy. So what you see in the table on the slide is that the asymmetric Gauge model that we use allows to reduce the root mean square error. So we have a better forecasting accuracy compared to other models. And what is interesting is that when you look at the worst 5% errors, which has the kind of extreme errors that you can make in terms of forecasting, we are also better than the other models. So we are not only better on average, but also when we look at extremes volatility. Yes, so I'm done on this part. I'll let Eric continue the presentation.
Apologies, I just had to unmute myself. Thank you very much for that, Daniel. And I also noticed that while Daniel was talking, we had a question about how do you reduce your exposure to the market using the cap-weighted overlay. The overlay, as the question implied, actually just uses a future. You can simply reduce your exposure using a future. We'll also come back to some of the more detailed questions that were asked as well. But let me just conclude this presentation now by looking at some of the properties and some of the performance of this dynamic defensive solution. We call it a dynamic defensive solution because we're dynamically controlling the volatility to maintain a more constant volatility throughout time. So in terms of the next few slides that we will look at 2 versions of this dynamic defensive strategy. One version is without the carbon filter and one includes the low carbon filter. Other than that, other than the carbon filter, the 2 strategies are pretty much the same. They're constructed in using exactly the same methodology. So we'll look at one with and one without the carbon filter. So in the analysis, we're going to perform this analysis over the last 15 years. But the first 5 years of the low carbon version is actually based on the version without the low carbon filter because we have the carbon data going back only 10 years. Okay, so let's have a look, first of all, in terms of what happens during market stress conditions. Because one thing that I've kept emphasizing is you want to avoid these spikes in volatility. So let's see what happens when volatility spikes. So let's see what happens in a low vol regime, and let's look at what happens in a high vol regime. So if we look at the first 2 rows of this table, you can see that in a low vol regime, we have pretty much the same volatility as the MSCI minimum volatility strategy. However, in a high volatility regime, where we're avoiding some of the exposure to the market, you can see that we have a much lower exposure during high volatility market regimes. If we also look at what happens in terms of low volatility and high volatility market regimes to the market beta, which I guess is probably even more important because that determines how much drawdown you have during during a stressed market condition, because essentially the market risk is the greatest risk that a defensive solution holds. You can see that on the far right-hand side, a strategy like the MSCI minimum volatility, what actually happens during a market crisis is the market beta of the strategy increases. Yes, it still stays below 1, but it actually increases compared to the market beta in a low volatility market condition. And this is why you're still exposed to a lot of downside risk in traditional defensive strategies. Now, introducing this maximum volatility control, you can see that the market beta of the strategy in high volatility regimes is significantly reduced and ends up actually being lower than the market beta in a low vol regime. So you're really taking money off the table, off the market, at a time when market volatility is very high during stress conditions. So this is one of the important features, and this is what happens when we introduce this maximum volatility control. And you'll see pretty much the same feature for the low carbon version as you see for the standard version without the low carbon. So really, the low carbon is an option that an investor can decide to choose in terms of performances and characteristics. You get pretty much the same characteristics whether you do low carbon or not. In terms of downside risk, so there are a couple of ways we can look at downside risk. One is just to look at the maximum drawdown. So you can see that a cap-weighted index, it had, over this particular period of time, had a drawdown of 57%, which happened during the financial crisis. And you can see on the far right-hand side, a defensive strategy like the MSCI minimum volatility had 10% less drawdown, 47%. Well, with this dynamic risk control, you can actually reduce the drawdown by a further 12%, a further significant improvement in maximum drawdown. Now, maximum drawdown only tells you what happens at one period of time, which in this particular case was the financial crisis. So it's also very useful to look at a rolling window of volatility. So we show here a 1 year rolling window and a 3 year rolling window of volatility. And we look at the 5% worst cases of 1 year rolling volatility and 3 year rolling volatility. And again, you see the same thing that, yes, defensive strategies tend to have a lower volatility on average compared to the cap weight, but our strategy ends up, the dynamic defensive strategy ends up having a rolling volatility, which is about half the rolling volatility of the cap-weighted index and significantly lower than traditional defensive strategies. So it's certainly going to help us in terms of reducing downside risk. And we know that this was very important during the COVID crisis because low volatility stocks didn't really help us very much during the COVID crisis, which can happen sometimes in certain market crises. This explicit control ensures that you have much better control of the downside risk and the worst instances of volatility. Let's also have a look at the conditional asymmetry of relative returns. In other words, let's have a look at the relative returns of our strategy in a bull and bear market, and let's also have a look at the relative returns of the strategy in a low vol and in a high vol market. So we normally observe that in a bull market, low volatility defensive strategies tend to underperform. We can see the MSCI min vol on an annualized basis underperforms by about 14% during a strong bull market. But because we have more positive exposure to the other factors, that helps us avoid some of this underperformance during a bull market, while still maintaining the same performance in a bear market as well. So this filter really has helped us reduce some of the losses relative in terms of relative returns during a bull market. And then if we look at it in high vol and in low vol regimes, what we observe again is that during periods of low volatility, defensive strategies tend to underperform because you tend to have positive returns. So what we see here is that during a low volatility market regime, we have much lower, if you like, relative returns. We have much stronger returns compared to the traditional strategy. But in a high vol regime, we have fairly similar similar returns. So it really helps us, not just over the long term, but it also helps us during bull markets, and it also helps us during periods of prolonged periods of low volatility in terms of return as well. So this is what we mean by the dissymmetric relative returns in these different market conditions. Okay, so this dynamic defensive strategy has some very interesting properties. But let's now also look at the overall performance of this strategy. Well, the first thing that we observe is that on average, the volatility of this dynamic defensive strategy, whether you do low carbon or not, is on average lower than the volatility of a classic defensive strategy like MSCI and Invol. It's about 2% lower, and yet it delivers